Jake buys the house. Marcus keeps renting. Same age, same income, same city, same starting cash. Jake feels like the adult in the room. He has the keys, the garage, the backyard, the fixed mortgage, and the sentence every homeowner loves to say, "At least I'm building equity." Marcus feels a little behind. Every month, he sends rent to a landlord and gets nothing on paper. No deed, no equity statement, no house appreciating in the background, and if you ask most people who made the smarter decision, they will answer before the math even begins. Jake did, because renting is throwing money away. But that sentence is only half true. And half-true money advice is where expensive mistakes live. Because Jake is building equity. But he is also paying interest, taxes, insurance, repairs, closing costs, selling costs, and the opportunity cost of locking almost $100,000 into one asset. Marcus is not building home equity, but if he invests the down payment and invests the monthly difference, he may be building something quieter, a portfolio. And after 30 years, the answer is not as obvious as people think. In this video, Teacher Ben is going to run the real math, not the emotional math, not the realtor math, not the landlord math, the real math. And by the end, you will see why buying can be a brilliant decision, renting can be a brilliant decision, and the real mistake is choosing either one while only looking at the monthly payment. Let's make the comparison fair. Jake and Marcus are both 32 years old. They both earn $100,000 per year. They both live in the same mid-cost, American metro. They both have $92,000 saved, and they both want to make the decision that gives them the strongest financial position by age 62. Jake uses his money to buy a $400,000 home. He puts 20% down, which is $80,000. He also pays about $12,000 in closing costs. So his full starting cash is gone on day one. He takes a 30-year fixed mortgage for $320,000 at 6.49%. That gives him a principal and interest payment of about $2,020 per month. Now most people stop right there. They compare that mortgage payment to rent and say, see, buying makes sense. But the mortgage payment is not the cost of owning a house. It is just the part of the cost that looks clean on a calculator. Jake also has property taxes. Assume 1.1% of the home value per year. On a $400,000 home, that is about $4,400 per year, or about $367 per month. He has homeowners insurance. Call it $150 per month. He has maintenance. And this is where the fantasy starts to crack. A house does not ask for permission before it breaks. The roof ages, the water heater fails. The HVAC system stops working in the hottest week of the year. The fence leans, the bathroom leaks, the driveway cracks. So we use a conservative maintenance estimate, 1% of the home value per year. On a $400,000 house, that is $4,000 per year, or about $333 per month. Now Jake's real starting monthly cost is not $2,020. It is closer to $2,870. That is the first number nobody likes to say out loud. The payment was not the cost. The cost was the payment plus the house. Now Marcus rents. He rents a comparable place for $2,100 per month. He does not own it. He does not get the pride of ownership. He cannot remodel everything he wants. And yes, his rent can go up. But he also does not pay for the roof. He does not pay property tax directly. He does not pay closing costs. He does not have $80,000 trapped in the walls. So Marcus takes the same $92,000 Jake spent buying the house and invests it in a broad stock market index fund. Then every month, when Jake's true housing cost is higher than Marcus's rent, Marcus invests the difference. In year one, Jake's real monthly housing cost is about $2,870. Marcus's rent is $2,100. The difference is about $770 per month. Marcus invests that. This is where renting stops being throwing money away. Renting without investing. The difference can absolutely become lifestyle inflation. But renting and investing, the difference is not the same behavior. One is consumption, the other is a strategy. That distinction changes everything. Now let's move forward. After 1 year, Jake has made 12 mortgage payments. But because mortgages are front-loaded with interest, most of that payment did not become equity. In the early years of a 30-year mortgage at a higher interest rate, the bank gets paid first. Jake's house may appreciate, he may feel wealthier, but his actual equity growth is slower than most first-time buyers expect. Meanwhile, Marcus's portfolio is volatile. It does not move in a straight line. Some years it goes up, some years it goes down, some years it makes him feel smart. Some years it makes him question every decision he has ever made. But over a long period, the math of compounding begins to work. And the first big twist happens around year 5. Jake has stability, he has a home, he has some equity. But if he has to sell, he has a problem. Selling a house is not free. Agent commissions, transfer taxes, repairs, concessions, moving costs, staging, and time on market can quietly eat a large part of the appreciation. This is why buying a house for only 2 or 3 years can be dangerous. The house might go up in value, and you can still lose money after transaction costs. That is one of the hidden costs of buying. A stock portfolio can be sold with a few clicks. A house must be marketed, negotiated, inspected, repaired, financed by someone else, and closed. Liquidity is not a small detail. Liquidity is financial oxygen. By year 10, Jake's story starts to look better. More of each mortgage payment is going toward principal. The home has probably appreciated. His mortgage payment is fixed, while Marcus's rent has likely gone up. This is the part homeowners are right about. A fixed-rate mortgage can become more attractive over time because inflation slowly weakens the payment. Jake's mortgage payment stays the same. Marcus's rent does not. So in the early years, Marcus has more flexibility. But in later years, Jake may start getting the advantage of a fixed payment. That is why the answer is not simply rent forever or buy immediately. The timeline matters, the city matters, the starting rent matters, the interest rate matters, the maintenance matters, and the human behavior matters most. Now let's jump to year 30. Jake has paid off the mortgage. His $400,000 house, growing at 3.5% per year, is worth roughly $1,120,000. That sounds amazing. And it is. He owns a valuable asset. But if we subtract potential selling costs, his accessible net value is closer to about $1,055,000. He also has a small investment account because later in the timeline, as Marcus's rent rose above Jake's cost of ownership, Jake could invest the difference. So Jake ends around $1,116,000 in this model. That is a strong result. Buying did not fail. Buying built real wealth. But now look at Marcus. Marcus started by investing the down payment and closing cost money. He invested the monthly difference when renting was cheaper. At a 7% annual return, his portfolio grows to about $1,185,000. In this specific scenario, Marcus wins by about $68,000. Not millions, not some fake internet number. About $68,000. And that is the point. The real answer is not that renting always wins. The real answer is that renting can win when 3 things happen at the same time. The rent is meaningfully cheaper than ownership. The renter invests the down payment instead of spending it. And the renter actually invests the monthly difference for decades. That last part is where many people lose the game. Because on a spreadsheet, Marcus is disciplined. In real life, Marcus may buy a nicer car. He may upgrade vacations. He may rent a more expensive place. He may keep the money in checking. He may invest aggressively, panic during a crash, sell at the bottom, and then say the market is rigged. This is the hidden advantage of buying a house. A house is not always the mathematically superior investment, but it can be a powerful forced savings machine. Every month, Jake has to pay the mortgage. Part of that payment eventually becomes equity. He cannot easily spend his home equity on random upgrades without refinancing or borrowing against the house. That lack of liquidity can be annoying, but it can also protect him from himself. Marcus has flexibility. Jake has structure. Flexibility is powerful in the hands of a disciplined person. Structure is powerful in the hands of an undisciplined person. That is why personal finance is never just math. It is math plus behavior. Now here is the most important part of the simulation. The result was very sensitive to the starting rent. In our example, Marcus rented for $2,100 per month. At that rent, investing the difference slightly beat buying. But if the rent had started around $2,143 per month, the two paths were almost equal. And if rent started at $2,400 per month, buying won. But if rent started at $1,800 per month, renting and investing won by a much larger margin. This is the number that matters. Not whether buying is good, not whether renting is bad. The number that matters is the gap between total ownership cost and rent. Most people compare rent to mortgage. That is the wrong comparison. You compare rent to the full cost of owning. Mortgage, property taxes, insurance, maintenance, HOA fees, repairs, closing costs, selling, costs, lost investment return on the down payment, and the risk of needing to move before the math has time to work. That is the full comparison. And once you run it that way, the emotional answer gets quieter. Now let's be fair to buying. Buying a home can make a lot of sense when you plan to stay for a long time. If you are going to be in the same place for 10 years or more, the transaction costs have more time to spread out. The mortgage begins to amortize more meaningfully. The fixed payment becomes more valuable. And the stability may be worth more than the spreadsheet can capture. Buying can also make sense when the rent for comparable homes is close to the full cost of ownership. If renting costs $2,500 and owning costs $2,800, the gap is small. In that case, buying may win because you get stability, potential appreciation, and forced equity building for only a modest monthly premium. Buying can also make sense for people who know they will not invest the difference. This is uncomfortable, but it is honest. If Marcus says, "I will rent and invest the difference," but then never invests the difference, he does not have a strategy. He has a slogan. And slogans do not compound. Now let's be fair to renting. Renting can make a lot of sense when home prices are high, mortgage rates are high, and rent is much cheaper than ownership. Renting can make sense when you may move within 5 years. Renting can make sense when your career is changing, your family situation is uncertain, or your emergency fund would be destroyed by the down payment. Renting can also make sense when buying would concentrate almost your entire net worth into one house in one city. That is another hidden risk. A house feels safe because you can touch it. But financially, it can be concentrated, one asset, one neighborhood, one local job market, one tax system, one insurance market, one climate risk, one expensive repair away from needing cash. A diversified portfolio is invisible. A house is physical. But physical does not automatically mean safer. It just means easier to emotionally understand. And that is where many people get trapped. They confuse visible wealth with better wealth. A house looks like progress. A portfolio looks like numbers on a screen, but the numbers on the screen may be more liquid, more diversified, and easier to rebalance. The house may be more stable, more useful, and better at forcing discipline. Neither is perfect. Both have traps. The trap in buying is believing the mortgage payment is the full cost. The trap in renting is believing the lower payment automatically becomes wealth. It only becomes wealth if the difference gets invested. So here is Teacher Ben's rule. Do not ask, is renting throwing money away? Ask a better question. After all costs, how much more does ownership cost each month? And what would I actually do with that difference? That question will tell you more than any slogan. Because if owning costs $800 more per month, and you would invest that $800, renting may be stronger. But if owning costs only $200 more per month, and you plan to stay for 15 years, buying may be stronger. And if you rent for less but spend the difference, buying probably wins because it forces you to build something. The payment is not the cost. The rent is not the waste. The behavior is the difference. That is the real math. So before you buy a house, run the full number. Before you keep renting, run the full behavior. Because a house can build wealth. A portfolio can build wealth. But pretending you are doing one while actually doing neither is the mistake that keeps people stuck. If this helped you see a number most people miss, hit the like button, subscribe to The Real Finance Math, and comment below. Would you rather buy the house or rent and invest the difference? And in the next video, Teacher Ben will break down the next question almost every homeowner gets wrong. Should you pay off your mortgage early or invest the extra money?